was the year of the rise of the Australian dollar and the fall of consumer spending and business sentiment. What does the new year have in store for us? A new report has identified the key themes likely to shape investing over the next 5 years, as well as the best 5 ways to benefit if and when they happen. It also details the 5 things we should avoid investing in, and some of them may surprise you. Well, for more on the findings of the Hi-5 2013 investment report, David Middleton from Middletons Securities joins us now from our Adelaide studio. Many thanks for joining us today, David. I understand it's a very hot and sultry 40 degrees there in Adelaide, so really appreciate your time.
It was pretty hot getting here.
I bet. Now look, the first theme, I guess, that really stood out for me in your report is that you see the value of the Aussie dollar falling this year. While some obviously have said that it could go as high as 120 US cents, why are you bucking the trend?
Well, I don't think we're the only people who are saying that there's a possibility that the dollar should fall. The terms of trade have come down by quite a bit, and in reality the terms of trade or the value of commodities have pretty much explained 85% of the changes in the currency price over the since the currency floated. And at the moment it seems to have not come down at all, but if you take a logical view that gravity eventually asserts itself, that sometime over the next 5 years we think the currency could well fall in value. Now, it may not happen, but it's plausible. So
how low do you think it could go this year?
Well, I don't know about this year. You see, the idea of the report isn't really so much about saying what's going to happen straight away. It's about what's likely to happen over a period. And it could happen quickly, or it might take a little longer, but it will certainly happen, in our view, unless commodity prices go up again. And really it depends on those commodity prices. The currency probably is really worth somewhere in the 90s now, but it could go lower, or you know, I don't know.
Okay. All right, you also see the US outperforming the Australian economy. What do you see as the major factors, I guess, holding us back this year then?
Well, a lot of it flows on from the lower commodity prices, and also a lot of the strength of the Australian economy has been in building in the development of the mining resources and the infrastructure that's required for that. And a lot of those projects are being put on hold. Here in Adelaide we've had the Olympic Dam exercise stopped. And so if that's the case, then a lot of the drivers of growth in the Australian economy will go away, and instead of having a 2-speed economy, we'll have a 1-speed economy. And the rest of the economy has been pretty badly damaged by the high value of the Australian currency, and also the higher interest rates here in other parts of the world. And so, meanwhile, across the Pacific, you've got the US that seems to be coming off the bottom. And so there's likely to be more growth there than perhaps we're going to see in Australia. In Australia we have our own fiscal cliff happening with the election, and both sides of the political spectrum seeking to demonstrate their fiscal responsibility. And if the Australian dollar does come down, we've got a fair chance of seeing a bit of inflation starting to happen in Australia, and if that happens, the Reserve Bank will definitely put up interest rates. So it's actually quite a complicated and difficult environment for the Australian economy over the next 5 years.
Okay, so in the shorter term though, in terms of interest rates, do you see the RBA holding pat in February when they next meet, or do you see several more interest rate cuts before we have to see rates go up again?
Look, I think there are people far more qualified than I am to reflect on short-term interest rate movements. But the Reserve Bank has form in trying to defeat inflation by putting up interest rates. And if we do see a fall in the Australian dollar, then we're going to see inflation happening, and we could see some reaction in terms of higher interest rates. And if that's the case, there's a whole lot of places that you don't want to be.
All right, what about when it comes to the share market? Do you see investment returns improving here in the next few years?
The earnings growth is likely to be slow in Australia if the scenarios that we've talked about come true. If we see a fall in the Australian dollar, if the commodity prices remain low, if earnings growth in Australia or if the economy starts to slow a little bit or isn't growing strongly, then earnings growth could potentially be quite slow or low in Australia. And that doesn't mean that we won't see good returns from the share market, because valuations are also low, and they're probably about 20% lower than they normally are, and so there's the potential for some increase. But it doesn't necessarily mean that we're going to see a return to valuations or values before back in 2007, because earnings per share have been diluted so much by capital raisings during the financial crisis.
Okay, so where or which sectors in particular do you see perhaps earnings growth be an issue in that bank space?
Possibly not so much the banks, because earnings growth might be low, but the valuations are also low. And also, one of the things that we think is going to happen over the next 5 years is an avalanche of retirement. That 10%, almost 10% of the Australian workforce is currently over 60, and a third of those are over 65. And people have been putting off retirement, and at some point those people need to come out of the workforce and into the retirement space. And if that's the case, then the banks that sort of control financial services in this country now will be beneficiaries of that. We think that probably the areas to be careful about really are, I keep on losing this earpiece, are small miners. We think the small miners or small resource companies are going to struggle, especially if commodity prices are down. It's the low-cost producers that are going to be the main benefit, or are going to continue to go quite strongly, but the small guys could struggle, especially those with quite a bit of debt. We think it'd be a bad idea to be too heavily invested in long-dated fixed interest securities. I mean, 10-year government bonds are giving them a touch over 3%, and inflation goes up, you're not even going to get an inflation return at that sort of rate, and so that's not a very good investment idea.
What about then when it comes to, I guess, times of uncertainty, when people look to fixed income and bonds as a bit of a safe haven?
Well, it's whether or not people are going to continue being uncertain. I mean, the world doesn't appear as if it's going to end. And if that's the case, then probably the idea of the flight to security or the flight to safety doesn't play out quite as much. I mean, there are plenty of places you can go for good interest income that just isn't a government bond. And there are index bonds or inflation index bonds issued by good corporates. There are deeply discounted income securities, especially some of the older style of income securities that provide very good income. And there's also income from infrastructure assets and from property assets that is quite secure now. A lot of these companies and businesses have restructured their business models. They've got low debt and very secure income streams, and you'll be better off there than in sitting in government bonds.
All right. Sorry, I'm just going to move on to another one of the areas you have recommended avoiding over the next 5 years. And perhaps not surprisingly, one of them is that you see more turmoil in that traditional media space. We have seen some of these companies now at very cheap levels, but you obviously don't see an improvement there.
Well, I mean, forecasting is really difficult. It's just a matter of saying, well, what are the probabilities? And there's no question, if you're a contrarian investor, then you could look at Fairfax and some of those companies and see pretty good dividend yields and also very low price to earnings ratios. And if you're heroic, then you could do well. I mean, it's quite likely that the news of the death of traditional media has been exaggerated. But at the end of the day, everybody is familiar with the changing business models, the fact that the rivers of gold of traditional media have disappeared, that circulation of newspapers have been going down consistently for about 27 quarters. It's a difficult road ahead, and when there are good opportunities for investment elsewhere, I don't know why you would take the gamble.
All right, David Middleton from Middletons Securities, really appreciate your insight and analysis this evening. It's been great to talk through some of the key highlights of that report with you.
Thank you very much.
Well, if you thought the so-called fiscal cliff fights were over, think again. There's a new batch of battles brewing in Washington over the debt ceiling, with the new